Boa tarde, hoje é terça-feira, dia 29 de agosto de 2023 e estamos aqui para mais um Oriz podcast, honrados com a presença do Mr. David Rosenberg da Oaktree. David Rosenberg ingressou na Oaktree em 2004, há quase 20 anos, e hoje ele é responsável como co-portfólio manager pelas estratégias dos fundos de high yield em títulos americanos e também na estratégia high yield de títulos globais. Ele se graduou na Universidade do Sul da Califórnia e tem também um MBA em Business Administration. A Oaktree, para quem não conhece, foi fundada em 1995 e tem hoje ativos sob administração, Assets Under Management, de 179 bilhões de dólares. O foco da empresa, muito ligado ao seu fundador Howard Marks, sempre foi crédito de empresas não grau investimento e também títulos de mercados emergentes. A empresa ela tem uma abordagem que nós chamamos de bottom-up, ou seja, o foco é a diligência na análise de crédito das empresas e menos nas variáveis, nas previsões macroeconômicas. Desde o início da Oriz, nós temos alocado dinheiro de nossos clientes em um fundo local que é disponibilizado para investidores brasileiros, o Oaktree Global Credit BRL, né? Esse fundo investe em mais de 600 diferentes emissores, a maioria deles nos Estados Unidos, mais de 60%, uma menor parte na Europa e também outras regiões. O foco sendo títulos em high yield e outros papéis. No Brasil é possível, e fazemos isso, investir nesse fundo com o hedge em reais, o que permite para o investidor que ele tenha um rendimento medido em CDI, né? E esse ano, até o início de agosto, esse fundo tinha um excelente retorno para os nossos clientes aqui, em torno de 128% do CDI. Esse podcast nós vamos fazer em inglês com Mr. Rosenberg, e depois teremos a versão em português. So, Mr. Rosenberg, thank you very much for being here. We are thrilled to have you here at Oriz Partners to talk about your expertise and Oaktree in relation.
Thanks for having me. Yeah, it's going to be fun.
We thank you for being here. And so just to be brief, we would like you to describe Oaktree and what it makes its approach different from other alternative investment firms.
Sure. So Oaktree is first and foremost a debt shop. We got our beginnings. High yield bond was the first strategy at Oaktree, and I think everything that has grown from there has really been kind of a natural step out. We do distressed debt, which is really risky high yield bonds. We do convertible bonds, which would be high yield bonds with an equity kicker, and we now do loans and other forms of debt. But I think because we started as a debt shop, the core of Oaktree always goes back to credit. I think credit research and credit analysis is where we add our value. And so, there's lots of ways with managers to think about attribution. People like to talk about attribution. How did you perform? What drove your performance? At Oaktree, we find over the long term, quite simply, attribution is really driven in debt by avoiding defaults. Our chairman, Howard Marks, likes to say, if you avoid the losers, the winners take care of themselves. And the reality being that when you buy debt is asymmetric to the downside. There's only so much upside. It's limited in its upside because the debt instruments are callable halfway through their life generally, and they mature at par. But if you pick the wrong instrument, it can go to zero. And so what we've found at Oaktree is if you can do a good job of avoiding problems, then you'll end up with superior performance over the long run. And I think that's even more important if you find yourself going below investment grade. I like to say a lot, in below investment grade, you're already getting a good yield. So you don't have to be a hero and go reaching for big winners. The key is to keep the yield. Don't give it back to defaults. Don't give it back to credit problems. And if you can do that, you'll find that you'll outperform investment grade over a long period of time.
Great. I would like to mention to you all that at the end of June, Mr. Rosenberg here and the founder, as I said, and currently co-chairman of Oaktree, Howard Marks. By the way, he recently was in Brazil. I attended to his presentation. They recorded a very interesting and I would say very insightful podcast titled "This Time Might Be Different." Right? I recommend to all of you to listen to this very insightful podcast. It's in Oaktree's website, right? And the main takeaway, I would say, to me at least, was that you both talk about the end of an era of ultra low interest rates, right, and cheap financing that came with it also, that we had at least until the pandemic in 2021. Could you expand then on this idea? Why should we live now with the environment, or why should we have higher for longer from now on?
So two things I'll say, why we should have higher for longer and what I think it means for credit. I think when you think about interest rates in particular, most people, for some reason, which I have yet to quite explain to myself, the market always talks about in the U.S. the Fed either hiking or pivoting and bringing down. Nobody talks about the middle, which, by the way, is quite a logical place to be most of the time. And so we've been through a period of dramatic hiking, and now the market has been laser focused on trying to figure out when the Fed's going to turn around and dramatically start reducing rates. And I think, when we first started looking at that, if you went back probably 6-7 months ago and you looked at the market, the way the futures market was predicting rate moves was basically saying that the expectation was we were going to have a soft landing recession, probably already right now, if you believe back, the prognosticators back then. And then by the end of the year, interest rates were going to be 100 basis points lower. It never really made any sense to me. Because what I used to like to ask people all the time is to think about why in the U.S. the Fed would pivot. And as much as I understand why everybody wants the Fed to pivot. It would be great. We have a soft landing, interest rates go down anyways, stocks trade up, bonds trade up, and we all can make a lot of money. But you think about why the Fed pivots because there's a crisis. Something bad has to happen, and they have to step in to aggressively lower rates in order to keep the economy moving, which means that if we have a true soft landing, everything's fine. There's no reason to aggressively pivot. And conversely, if we find ourselves with rates 100 basis points lower at the end of the year, then there was no soft landing, something bad has happened. And so I think we're in a period right now where the market is coming around to the reality that it's not terribly logical for the Fed to turn around on the heels of spending years fighting inflation to do something inflationary like aggressively lower rates. It's much more logical that rates just stay where they are for a while, and the Fed takes a step back to say, let's see what the impact is on the economy of all the stuff we just did before we turn around and lower rates, especially if we found a way to navigate this in a way that the economy actually hasn't suffered any severe harm. However, if that's the case, and you're in a higher for longer environment, or as our co-chairman would say, high for longer, because it doesn't necessarily have to keep going higher, but just stay where it is, that changes the math for a lot of these companies. You have floating rate companies that are paying that higher rate already. And so the longer rates stay where they are, the more interest they have to pay, the less free cash flow they're going to generate. If you have a fixed rate company, that means when they come up to their next maturity, if you think about over the last year, coupons have effectively doubled. And so as companies go to refinance, they're going to have to now face the prospect of paying twice as much interest on that same amount of debt. And so we've gone through this period of easy money. And I think what happens in an easy money period, market gets somewhat complacent because nothing ever really goes wrong when there's easy money. You just keep borrowing more and you can paper over whatever problem you may have. Now, I believe, biased as I am, we're entering into a period where credit selection is going to be very, very important. Because if you can pick the companies that can afford their debt, you're going to do very well. The yield's already very high, and you're going to make a good yield. If you're just riding the tide with everybody else in the market, you're going to find some of your companies can't pay, and that's going to take away from that yield you're supposed to earn. So I think this higher for longer also means that credit is going to be very, very important.
Excellent. That brings me to my next question, referring to the Jackson Hole conference that we had recently. As you mentioned, Chairman Powell in his speech didn't seem like someone who's going to pivot anytime soon.
No, quite the opposite, right?
Yeah,
For months now, it's funny because we've been in a market that has been so resolute in its desire to believe that the Fed was going to pivot, that I used to joke that it's like good news is bad news is good news. So you have earnings are bad, that's good, because now the Fed's going to have to pivot. And I would joke at people and say, no, bad earnings is bad. And you need to kind of internalize that. And I think Powell for a while now has been begging people to listen, saying, I am not lowering rates, and the market just didn't believe him until I think more recently.
Sure, and it caught my attention also the presentation by Christine Lagarde, the president of the ECB. She spoke in length about the challenges that central bankers now face because of the transition that you are seeing globally, the energy transition, the new trends related to reshoring, nearshoring. Yes. And she said that this is adding new investments to areas where you don't have enough supply. So we are living also with some supply shocks that are not contributing to disinflation.
Yeah, quite the opposite.
Exactly.
Yes.
So that brings me to the point. In this, since you referred to the need to be very careful with credit right now, who do you think are the winners and the losers in this environment if we look at sectors?
Yeah, it's a great question. So when I first kind of, came to this epiphany that, rates were going to stay higher for longer, and you kind of take it to the step, the reason staying higher for longer is you have central banks that still need to fight inflation. Inflation's come down quite dramatically, but it's not at the 2% target, and I think it doesn't naturally get there. That's a pretty aggressive target to have, and there's likely going to be a little more pressure from central banks to get there. But if you think about simplistically what that means, if you're fighting inflation, basically what you need to control inflation is you need people to stop spending money. You keep spending money on higher and higher priced goods, you're going to have more inflation. And so if you have central banks, which are a fairly formidable opponent, attacking the consumer, I think central banks need the consumer to feel less wealthy so that they spend less money, so you have less inflation. That's not very good for consumer-focused industries. So for me, when I look at industries like retail, specialty retail, or even auto, where it's more discretionary in its spending and it's dependent on the consumer to be spending money, those are sectors that I've been shying away from. When you go to sectors that are a little more steady in demand, whether it be a utility, whether it be a healthcare company, whether it be food and beverage company, more GDP-like in its growth and demand, that to me is a little more attractive right now. But I also all this comes back to the fact that I think it's very difficult, and I guess time will tell. These things are impossible to predict, but I don't think it's heroic to say it's very difficult to imagine that the central banks are going to get inflation all the way to 2% without creating some form of recession. And so I think that's, to me, very much still in the cards. We hear the no landing camp. It used to be, I remember back in the day that soft landing meant no recession. Now soft landing means benign recession, so they've come up with no landing to have no recession. And that camp's getting louder and louder of people, believing this is going to be the first time, and I guess there's a first time for everything. Sure. I'm not yet a believer. So I'm a little more cautious. I'm looking more for companies that, in sectors that don't need growth. You don't really want a company that needs to grow into its balance sheet. That's difficult to deliver when you have a recession coming. But if you look at sectors where it's more stable and it's just, kind of the stable, boring, cash flow story, I always say boring is beautiful for bonds. And so good, boring cash flow streams is generally where I'm looking. And it's funny, if you think about this for a second, it's one of the reasons why I do actually believe over the next 5 years debt will outperform equities. And I think that's not something you can usually say just because of the asymmetry of a debt instrument. But think about it, equities need growth. right? That's underpinning the value of an equity is how much is it going to grow and what multiple do you want to put on that growth. And over the last 5+ years, we've seen tremendous growth because money has been free. And it turns out when money is free, you can borrow a lot of it. And if you can borrow a lot of money, you can invest in a lot of growth initiatives and you can see all these multiple expansion. And now the very reason I believe debt is attractive is because money is expensive, which is the very reason I think equities are going to become less attractive, which is now you can't afford as easily to finance your growth initiatives, which means you should expect to see less growth.
And that very interesting because it brings me to the point. There's of course, the counter argument, which is that, and you talk with Mr. Marks on your podcast about this wall of refinancing that lies ahead of us, and in I believe 25 onwards, and that makes some people argue that high yield spreads in the presence of such a challenge, they would be too low because of the historical norm and so on. What would you say about that?
So there's a few things about that. I do think the maturities, if you look over the next couple years, so 24, 25, maturity wall very, very low. Because what happened was during 2020, during COVID, when the central banks flooded the market with liquidity to keep the world moving, everybody looked and said, well, if money is so cheap, I'll refinance now. So maybe I wasn't planning to refinance for 2 or 3 more years, but I'm going to do it now because I want to lower my cost of capital. The ancillary benefit of that is you push out your maturities every time you refinance. And so there's a brief window where the maturity wall is pretty low. But as you point out, it does inevitably pick up. And really 26, 27, it starts to pick up. And the reality is if it's picking up in 26, 27, you got to refinance at least a year early. You can't wait to the last day because if you're too cute with that, you could risk losing your company because you're playing games with your coupon on your debt. That doesn't make any sense, and that's irresponsible for a CFO. And so, if your maturity is in 26, you got to refinance it in 25. And the market's forward-looking, which means the market's going to start thinking about it in 2024, which isn't that far away, right? And so when you think about the upcoming maturity wall, I think it is something that, again, going back to the credit pickers market, there's going to be a separation. Now, when you talk about spreads, that's a very important topic, I think, today, because we've been in a low-rate environment for so long that the market has built this muscle memory that, you buy only on spread. When spreads are tight, you sell. When spreads are wide, you jump in and buy. When spreads get tight again, you jump out. And that's worked for a while, and you kind of needed that because if you think about high yield as an example, if you're only earning 4 or 5% in high yield, which that was the yield not that long ago, then you need an element of total return on top of that. It's just not going to work for anyone's portfolio. What's interesting today is now you've got high yield at 8-9%. You've got our global credit portfolio you talked about before at 10.5%. And so when you're getting double-digit yields out of credit, now people are stepping back. I'm observing and noticing that there's really 3 elements to value. Spread is important. Spread is the compensation for bearing risk over the risk-free rate. It's important. But there's also price and there's also yield. And so if you look at the 3 metrics, you'd say, to your point, spread's okay. It's nothing special. And if there's a recession, yes, I think it probably does widen. I think that still holds true. Yield's very attractive. You're in an equity-like return on your yield. And the price is very attractive. You're buying at least 10 points below par. And that's quite unique. Usually with credit, you have a recession and then everything trades off to 10 points below par. You don't usually have a discounted average market before the crisis or recession hits. And when you can buy below par, you get 2 things. You buy at 90 cents on the dollar, for example. I have less downside because if I go into restructuring, I don't need to be worth 100 cents on the dollar. If I'm only worth 90, I get all my money back. And I get more upside, and potentially, because if I retrace par before maturity, I'm going to earn more than my yield. And as we talked about before, refinancings generally happen at least a year before maturity. So while the yield to worst assumes you stay out to the last day of maturity, in reality, that's not the case. So there's a hidden yield in there with a discounted bond price or loan price. And so I think that when you look at that now today, what I'm starting to see, more and more investors say, yes, if a recession hits and the maturity wall starts to become an issue, spreads are going to widen. But do I really care if I'm going to earn 10% out of my credit? And most people, if you say, hey, is there a place in your portfolio where you can lock in 10%? Does that work for you? And most people say, yeah, if I can lock in 10% over here, I can go over there and do really risky stuff like private equity and distressed investing, and I can have the comfort of doing that with that potential upside because I've gone over here and locked in a 10% without having to take a lot of risk, by the way. 2-3 years ago, 10% would have been a really risky portfolio. Today, average quality around single B. And so I think what you're seeing more and more investors say, yeah, spreads could widen, but what I always tell people is you should be incremental. One of the tenets of Oaktree's philosophy is you can't time the markets. I've been doing this about 20 years, so I've learned a humbling lesson of trying to time the markets. Not easy to do. And so I tell people is if 10% works for you, you should buy some today. If you think a recession's coming and you think spreads are going to widen, then leave some dry powder because averaging in is always a good strategy in investing. But you should buy some because like we said before, I think a recession's coming. But there is a louder and louder camp of no landing that says maybe it doesn't. And if you wait for the spreads to widen to that level, you might miss the whole opportunity to get equity-like returns out of debt. And so I think that, to me, is kind of the perfect balance of the two.
Very interesting. And I also wanted to know about the point you make in the podcast when you refer, and I think it's what you were referring to, that buying high yield was more in the past more opportunistic,
yes,
about spread compression, and now it's become more of a play of kind of a carry trade. And
that's right.
I bring that to the conversation because in Brazil, Brazil has a fixed income bias because of high inflation and high real interest rates and so on. So it seems to me that the kind of product that you are offering here, I think it matches this Brazilian culture of buying and hold. However, we don't have always good credit quality in Brazil, and bringing a fund that, as I said at the beginning, has more than 600 issuers is a very smart way of earning high yield and diversifying the credit risk.
I think it's really important. I think, look, we don't always have high quality issuers in the U.S. or Europe either. And so the reality is, there's been this muscle memory or laziness, if you will, built into the market over the past, call it, 5 to 10 years, frankly, because in the U.S. it's what people call the Fed put. I would talk to people all the time about below investment grade investing and say, look, the key to all of this is credit. You have to have your credit analysis down, and you have to be able to make sure that you keep yourself out of defaults. And if you can do that, you're going to do very well. And for the longest time, people would say to me, I don't have to worry about credit. I have a Fed put. And it was very frustrating because they were right. I mean, you think about it, we had a global pandemic. The entire world shut down, and 2 weeks later, the market was back off to the races. All you had to do was hold your breath for 2 weeks, and the Fed came, and the central banks around the world came and bailed you out of all your problems. And so my favorite question to people was, that's great. You have a Fed put. What happens when the Fed wants to bail you out and can't? What are you going to do then? And everyone would say, what do you mean? The Fed has unlimited tools. They can do this forever. And I say, well, forever is a pretty long time. Are you sure? And now I think we're finally in a market where a central bank cannot fight inflation on one hand and support a market on the other. Those are in direct contradiction with each other. And they've picked inflation, appropriately so in my opinion. But that means you have to do your own work. And so I think that, to your point, whether it's Brazil or just globally in markets right now, I think that it's going to become very, very important with rising rates, with maturities coming up to, find managers that actually know how to manage out their credit risk and see the problems in advance and avoid them. If you can avoid the defaults, as we said earlier before, if you can avoid the losers, the winners take care of themselves in credit. It's kind of the Oaktree tagline. And I think that's really going to be key.
And of course, in Brazil, we know a lot about why you need to be so diligent with credit quality. As we were discussing earlier, we just had this year, unfortunately, 2 major credit problems with Americanas. By the way, Americanas would be American, right?
Right.
And so you were to blame in that case.
That's often the case.
Because the retailer, it was a very huge, high-profile default, and also Light, a utility company. And it brings me to the same point that we sometimes think that single credit names are robust enough, and we bet on that type of risk with a relevant amount of our portfolio, and why not diversify?
To me, it's so clear when you have debt. It's not like a venture capital portfolio. You think about it this way: one winner wipes out 5 losers.
Exactly.
Right? You can have names go 2, 3, 4 times up in money. In debt, generally we say for a fixed income security, if you have a bond, the very best outcome is that the bond gets, we call it tendered. So they want to take the bond away from you before it's callable. And if they want to do that, they have to pay a premium, because that was the deal. We gave money to the company with the expectation we're going to get a fixed coupon for a certain amount of time, and if you want to get rid of it early, you have to pay a premium. Simplistically, that works out to call it 120 cents on the dollar. It obviously depends on the treasury at the time and so forth, but simplistically, that's roughly where it would be. So in this case, you have the opposite of venture capital, because one loser can wipe out 5 winners,
Sure.
right? Because the loser can go to 0. Exactly. And so concentrating mathematically doesn't make any sense, because I tell people all the time, you could have the best bond in the world, but if you're right, the goal is you're going to get your money back plus your coupon. That's it. All the rest of the upside in the company accrues to the equity holders. So you're much better suited to diversify the portfolio, because things will go wrong. And they may be obvious in hindsight, but they're not always so easy to spot, especially if there's fraud or in the company's actively trying to hide what's going on. And so when you have a skilled team, you'll see warning signs along the way. Things don't look right, and you'll move out of a portfolio, you'll move out of a name. But more importantly, you diversify the portfolio. It allows you to guarantee the income. Right? The purpose of the high yield product is to get the yield. It's in the name. And so the diversified portfolio delivers more of a steady income, because if there's any one shock one way or the other way, it's not going to meaningfully impact the income of the portfolio. And I think that's very powerful.
Sure. And as you said in the beginning, low interest rates and cheap money makes us complacent.
Yes.
What we had in Brazil in the last few years was the credit market expanded, and that was very positive, but I think yields were too compressed, and we need to remember that in Brazil, all companies, with maybe 1 or 2 exceptions, they are high yield companies, because we are not an investment grade country. And so that I think is important. Investors, sometimes they are faced with high yield investments in the US, and they think it's too risky when they don't realize that they themselves are investing every day in high yield companies in Brazil.
I think people forget that debt is a contract. That's the beauty of debt. It's a contractual return. And so if you can be good at weeding out problems, you get to sit back and earn a contractual return. And it's funny, because I've been doing high yield in one form or another my whole career. And so you talk to people and they say, oh, high yield is really risky. And I say, yes, it can be risky, but do you own equities? And they'll say, of course. And so you do realize equities are riskier than debt, because that's how the capital structure works. And so there's this, view by the market when they hear the term high yield or junk, that everything's really risky. But the truth of the matter is, there are some very good companies in there. It's become a much more mainstream place for the market to raise money. It's not really a mark of shame anymore. It used to be at the beginning, when this market was created, when our founders were in the high yield market when it was created, it was a mark of shame. You needed to be investment grade or you were a bad company. Today, there's many mainstream companies that are perfectly happy to stay in high yield. So you can build out a portfolio that is quite clean, despite being in high yield. The other thing about high yield, which I think is funny today, when you talk about quality, is that while there is risk all around the world, in the U.S. in particular, the quality of the high yield market is very high. And so it's an interesting dynamic. You have, because of COVID, when COVID hit, you had all these investment grade companies fall into our market. So we call them fallen angels. And so right now, the percentage of the market in high yield that's rated double B, so it's the highest quality of high yield, is the highest it's been in over 10 years. And the percentage that's rated triple C, which is the lowest quality of high yield, is the lowest it's been in over 10 years because during COVID, again, all the risky companies defaulted. They fell out of the market. And so we've had this cleansing of the market, which is quite interesting because usually you don't have a cleansing event before the recession. Usually the recession is the cleansing event. But we've had this cleansing. And so now we actually have a market where the yield is high and the quality is very high. And that's rare.
Yeah, very interesting. And one last question, I was almost forgetting to have you share your views in terms of U.S.'s fiscal deficit. Is this an issue also on this new environment of higher
I think it will
yields?
be, and I think that the reality is the higher yields stay, the more interest needs to be spent on the deficit, the more you have to borrow to pay your interest, and so I think it's something that politicians are watching very closely. It's why I like saying high for longer instead of higher for longer. I think that there, could rates go up 25, 50 basis points more? Sure, I don't have the expertise to know, but it's hard for me to imagine it gets dramatically higher from here because the debt also has to be repaid. And so I think there's going to be considerations in that regard as well. So definitely a factor. And in 2024, we head into an election year, and it's become an even bigger factor. Everyone's going to be talking about that and how we're going to get that under control.
Sure. Mr. Rosenberg, I want to thank you again very much for being here today.
Pleasure.
And I would again recommend to our listeners to go to Oaktree's website and see the insightful remarks that you both made, you and Mr. Marks, and also recommend to our viewers and listeners, take a look at Oaktree's funds. They are available for local investors. As I said, you don't need to be offshore.
That's correct.
And that's a good idea of diversifying credit risk. Thank you very much.
Thank you for having me.
Welcome.